What's going on, guys? Stocks by the numbers. Welcome back. Wanted to take a quick look here at a company that someone asked me about just the other day, so I thought we'd take a look at it here. The name of the stock is Vimeo Incorporated, ticker symbol VMEO, listed here on the NASDAQ. There's a nice little tech stock here trading, as we see here, $3.72, up 2 cents, 0.6% here on the day, right? So we have a nice cheap stock, it's under $5 a share. But let's see if the numbers actually line up with what's going on. Now, as of late, you can see Jefferies downgraded them to a hold from a buy, just a price target of 4 from 7, okay? Now, in my opinion, first glance of the numbers, 7 doesn't seem too crazy. To lower your price target to 4, again, this is what makes me laugh about these analysts. The stock is at 4. Right? So saying it could go to 4, I mean, essentially you're useless, right? We don't even need your analysis. But anyway, let's push that to the side. So let's check out some of the numbers here. So 620 million, we'll call it market cap. We have a PE 75, okay, which obviously could be viewed as a little high. Usually, industry average, depending on the sector, could be anywhere from like 16 to as high as like 25 when we talk about tech stocks. And I'm sure we've seen a lot of other stocks even higher than that. But let's take a look at these numbers here. So the PE does look high. The beta, as we see, a little over 2 again. The beta is the volatility of the stock in correlation with the overall volatility of the market. So that means this stock is twice as volatile as the market. But if we look at the EPS side, we can see when we're talking about profitability, Vimeo has been absolutely smacking the ball over the fence and just hitting home run after home run, completely turning around their profitability. Now, I understand also that if we go back here, we can see August 2022, boom, we shot down, and we've been in like this downward consolidating channel here since then. But if we look at the actual numbers that came out, as you see here, beat back here, August 2022, beat on the top and bottom line. Next quarter, beat top and bottom line, beat, 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 beat. So even though some of these estimate numbers have decreased, right? 101, 100.5 million, look, coming from 102, coming from 105, coming from 106, right? So the estimates are slightly ticking downward. However, Vimeo is consistently beating and coming in above those expectations. So you can't really knock the company, whether estimates are, up, down, or sideways. If they're able to come in above expectations, that's a good thing, usually not a bad thing. If we look over the years, we can see going back from 2019, the company was doing sub 200 million in revenue, then up to 283, up to almost 400 million in revenue, and then broke above that benchmark in 2022, 433 million. Now, if we switch over here, looking at quarterly, we see something very interesting because, again, 108 million down to 105, 103, 101, back up to 106, right? So the revenue has been slightly ticking down for a bunch of these quarters, but it did have a nice rebound here in Q3 of 2023. However, by basically just maintaining that level of $100+ million in revenue quarter over quarter, we can see, look at the profitability margin here going from minus 19.8% up to less than -5%, then almost break even, and then up to 5.6%, 7.8%, right? So right now, whatever they're doing, in my opinion, they seem to be doing right. Because even though we can say that, yeah, revenue isn't really growing quarter over quarter, fair enough. However, they are maintaining their current business level and, of course, making themselves more profitable. And obviously, Wall Street usually ends up rewarding stocks that maximize profits. So they're probably waiting, in my opinion, for a company like Vimeo to actually post that next chunk up in revenue. Where's the quarter with 110, 112, 115 million? So in my opinion, that's what Wall Street is waiting for here, which is why throughout all these beats, the stock has been in this downward consolidating channel. Because if we look at the numbers, first of all, I want to look at 2023, right? So we have 103.58 million for Q1 of 23. Adding that up there, we're looking at what, 205.3 million. And now with that, we're looking at 311, right, and a half, 311 and a half. And now this quarter will bring us to like 413, the high 413 millions, if they slightly beat, potentially 414 million, which essentially, I believe, is what they were forecasting for the year of 2023. So they will probably, of course, only time will tell. Anything can happen. These earnings aren't coming out until first week of February here, but if they continue what they were doing and they come in, high 102, low 103 million mark, chances are they'll probably be in line with that 414 million fiscal year estimate. Now, that is a good thing. However, if we switch over here, we can see that'll be the first dip in yearly revenue, right? So the company was on a roll here for these years, doing consistent increases in revenue year over year. Now revenue going from 433 million slightly down to 413 million. However, it does seem like they will be much more profitable off of 413 million as opposed to, again, losing about 18 1/3%, as you see here, off of 433 million. So, a couple of positives there. If we look at the forecast, we can see average 1-year price target almost $6, roughly almost 60% from where we are right now. We have 6 analysts currently looking at Vimeo. 4 of them giving it a hold, means, of course, they really have no idea what's going to happen. 2 coming out, putting their money where their mouth is, saying, hey, there's a strong buy. And again, as we see, price targets as low as 4, price targets as high as 7. The stock right now is at 370. So, chances are, again, obviously nothing is set in stone, but in my opinion, over time, based on what I'm seeing, this stock should continue to increase. Now, again, quarter over quarter, look at this, going back to tail end of 21, we can see over the last, 7-8 quarters, the company has not missed on the revenue side. Definitely nothing to sneeze at. And again, as we see here, the company was missing on the EPS side, posting a wider loss than Wall Street expected. And then they just immediately started to narrow it down and actually reversed it to net income positivity over the last 2 quarters. And that's why I'm saying, in my opinion, this stock actually should be getting rewarded. And a lot of the times, people get impatient, right? You could look at a stock like this, it looks good on paper, in my opinion anyway, and we can say, okay, revenue is stable, they turned the profitability around, they're making what, 400 million a year right now in revenue, and market cap's only 600 million, right? So they're trading 1.5 times market cap. So that's why a stock like this, very similar to something almost like a Fubo, right? Fubo began to beat analyst expectations on the revenue side. They turned around the profitability and stopped the bleeding. Then all of a sudden it became attractive and it started to climb. But if you recall, when I first initially looked at it, the stock was at $1. And in my opinion, I came to the same conclusion that, yeah, this stock should definitely be higher. But what happened? The stock ended up going lower first before it went higher. So this is why we say all of these rules, like, stick to your guns, stay confident in your analysis, remain patient, right? Take what the market gives you. And essentially, it's the same thing here, right? If we're looking at the numbers and we come to the conclusion, hey, it looks like a buy around here, 370, 380 a share, anything under $4 would be good. So if you begin today, hypothetically, to piece your way into the stock at 370, and then it drops down to 350, is it going to suck? Yes. Obviously, this is why, again, I always say you never really just go all in. And I specifically tell you guys and use that terminology, in my opinion, to piece your way into a company. Because you never know what's going to happen. Because again, in my mind, a stock like Fubo should have, no matter what, not went lower. And it went from $1 when we first looked at it down to new lows of like 70 cents, right? So that's a 30% sell-off instantaneously. So if you went all in when we first found it at $1, yeah, that would have sucked and you would have been pissed off saying, oh, I could have got X amount of more shares at a cheaper price. Or, obviously I could have got a lower cost basis, blah, blah, blah. But again, at the same time, that's why I say, in my opinion, it is more advantageous, it seems like, over time to piece your way into a stock. Because if you're confident that a company like Vimeo here is going to go, let's say, from $3.70 to $5, right? That'll be about a 30% move, which is phenomenal. But if you begin to buy here at $3.70 and they continue to beat it up, and it doesn't necessarily make sense on paper, well, then it's like we always say, if I liked it at $3.70, I'm going to love it at $3.40, $3.30, wherever the hell they might take it. So that's why, again, we all want immediate profits. And I think it was platforms like, on social media that actually kind of destroyed everyone's perception of, in my opinion, what they're really supposed to be doing in this market, which is buying good companies at fair valued or a discounted value. And instead, everyone just wants to roll the dice with these crazy option strategies because we're seeing posts of people 1,000%, 1,800% returns within the next day. So everyone wants to take all that risk. And then when they end up getting smacked up and the account ends up dwindling down to a low or a worthless amount, then that's when they take a step back, and now we have to do research and we have to accumulate more knowledge and move it into the next phase of our account when we refund our account and then try to trade and invest again. Meanwhile, if you look at how the stocks perform over months and over the years, even on this channel alone, we've looked at a lot of stocks that were just trading at deep discounts in the numbers that happen to go on these nice runs and these nice rallies over the months and over the year plus. So that's why, in my opinion, I always say I'd rather work smarter than harder. And I appreciate the fact everyone wants quick money. But again, if you are able to accumulate shares of Vimeo down here in this consolidating channel, yes, it's going to be slow. Yes, it's going to be boring. But again, look at how high the stock was and where it came from. So even if it breaks out of this channel and begins to climb back to where it was, I mean, we're talking high fives, potentially $6. Right here at the top of the range, you can see 770 where the peak was of this consolidation area right here. We have, looks like a tiny little gap down. Of course, it was filled immediately and came back down. But even if it gets back to the gap, you can see you're talking $7.50, potentially $8 a share. And right now the stock's at 3 and change. So that's why if they beat it up and bring it down here to the bottom trend line, 304, yeah, it's going to suck because it just technically fell off a cliff right as you started buying it. However, again, if I like it at 370, I'm going to love it at 304. And right now, again, in my opinion, with the way they turned the EPS around and how consistently they've been beating estimates, not only on the EPS side, but of course on the revenue side as well, we could potentially say the PE is high. However, overall in the numbers, in my opinion, this stock is undervalued. And we're talking about a tech sector that is completely flying. Markets were down today on this inflation data that came out because, again, even though they were trying to say that inflation was cooling, people in the Discord could attest to the fact that I was consistently saying that we should not be going higher. And if you left the house and actually went to these stores, and utilized some of these services around, you will see that inflation is very real and it is continuing to increase. It is not cooling by any means. And this is what they do. This is why I say these random BS pumps, in my opinion, are literally the most dangerous things that can happen to traders and investors. Because it gives a false sense of reality, a false sense of confidence, and now all of a sudden, oh, inflation is up, it's not cooling. Oh, and by the way, it looks like Fed isn't going to cut rates. Okay, well, we went on an 8-week rally throughout November and December off of those BS headlines that you were feeding everyone. Now, it looks like all of that was fugazi and none of that is coming to fruition, and it's actually the opposite of the landscape that you painted just a couple of months ago. So that's why, in my opinion, again, I'm not trying to scare anyone or be a pessimist. However, simple logic and common sense tells me if we went on an 8-week rally off of BS data that wasn't real, now that the data is real and it's negative, we should technically give back all of the gains that we got in November and December. But again, going off on a tangent randomly. But here in the chart, we can see since last earnings, we kind of have like a trumpet taking place. However, we did make higher highs and we are making higher lows. So we should technically continue to go upward. And I wanted to take a look here quickly because I wanted to show you the debt. Look at the debt here over the years going from 102 million down to 96 in 2020, and then coming out of said pandemic, debt actually decreased and dropped to 14 million 2022 back up to 19 million. But look at the cash as well. Cash jumps from 110 million to up to about 300 million and change, and it's been maintaining. Look at that, 273, 274, 268, 278 million, 290 million as of last quarter cash and equivalents. And also the debt here, 15 million up to 19, back down to 14.6, 14.1, 13.6. So the company, unlike a lot of other smaller cap stocks that we looked at, really doesn't have any real debt on its balance sheet, which of course adds more value, in my opinion. right? So if they're doing about 400 million a year and the market cap 600 million, again, we can say, okay, they're trading about 1.5 times annual revenue. But if debt was like 200 million, then we can say, all right, we can understand as to why Wall Street is keeping them down, right? Because they're making a couple of hundred million a year, but they owe a couple of hundred million. So technically, like the growth of the business is like half value because they're only really getting like 50 cents of every dollar because of all the debt on their balance sheet, right? I'm sure that kind of makes sense. So that's why seeing something like this, with them able to maintain revenue, increase profitability. However, they're actually not only keeping debt in check, but it's actually seems like it's decreasing and being paid off here while the cash is being maintained and actually increasing again. 268 million, 278 million, 290 million. So that's why, in my opinion, overall, the company definitely has more positives outweighing the negatives. We have assets outweighing liabilities here. But the debt I wanted to show you. That's why I switched over to that graphic. And also the revenue. Look, again, it is bouncing around. However, we can see we're kind of staying between this like 100 and $110 million range. So the company is doing consistent business. But more importantly, here with revenue jumping back up to 106.25 million, look at the cost of goods decreasing from 28, 29 million. Look, down into the 26s, down into the 25s, 23. As of last quarter, only 22.32%. Now, it's only a couple of million less. So a lot of people may look at that and say, meh, it's not a big deal. Let me tell you something. That is a massive improvement, and that is a very big deal. Revenue, 108.3 million. Now this quarter, 106.25 million. However, again, from 28.4 down to 22.3 million, you're talking about a 25% decrease in cost of goods sold, which usually, looking at a lot of these companies' income statements, could be the dagger in the heart, so to speak, of how they end up with negative income, right? It's because the cost of goods sold mixed with the operating expenses as well just eats away at all the money that they're actually making. So they end up being net income negative. And again, losses widen, and that's when we have to raise cash and do offerings and potentially dilute the stock, or the stock may drift down towards that dollar range, and then we'll have to do a reverse stock split to maintain our listing on the NASDAQ or whatever, right? You understand what I'm saying? So the fact that the cost of goods have dropped down 25% with the revenue maintaining itself, phenomenal, in my opinion. Absolutely phenomenal. Look at the gross profit now off of that quarter, the highest it's been going all the way back to early 22 there. Operating expenses, same thing. Look at this. 100+ million for multiple quarters. Drops down into the 80s, then into the 70s, sitting here currently at 78.75. Yes, it did go up a couple of million, but again, the revenue did increase a couple of million from the last quarter as well. So it's understandable that they may have spent a little bit more on the operations to generate that increase in revenue. However, going from 106, 108 million down to 78 million, again, we're talking about, 25%, 30% drop here in operating expenses. That is nothing to sneeze at. And gross profit minus operating expenses gives us operating income. And as you can see, we went from negative tens of millions up to just a couple of million, less than a million. Now we're positive, 4.5 million, 5.18 million. So that's why this company on paper, in my opinion, is looking very nice here. Is looking very nice. As we see, the liabilities are bouncing around here, but we did go from 260 million down to 243 million, we'll call it. So that's about a 10% decrease. While assets, again, they have decreased from 622 million down to 609, where it is now. But I feel like the liabilities chunked down more of a percentage than assets chunk down, right? So we're maintaining or slightly losing a little value in our assets while actually attaining a nice 10% drop in our liabilities. So that's why they're not technically in proportion, and the decrease of liabilities is actually outpacing the increase of assets, which, as you see here again, assets minus liabilities yields total equity. And as we see, total equity, 366.75 million, we'll call it, which is the highest it's been going back the last 6-7 quarters. So that's what I mean. This company, in my opinion, really seems to be doing a lot of things right here. And again, the debt was smaller, however, the debt was larger, and now it's sitting here at only 13 million. Again, compared with a lot of stocks that we look at, some of them have like half their market cap currently in their debt holdings. So the fact that this company only has, 10, 15 million in debt, I mean, that in my eyes is pretty good. And the book value we can see has been maintaining this $2 plus level. Now it's up to 219, the highest it's been going back the last 6-7 quarters. Again, in my opinion, a lot of positives here. A lot of positives. We can see the cash from operating activity jumps up to 16.6 million, right? It was negative, slightly positive, a couple of million. Boom. Look, now even as of last quarter, 12.4 million, 16.6 million. These are good signs here. These are very good signs. But overall, again, I like it. Price to sales, we're sitting here 1.4, right? Currently 1.47, but we'll look at last quarter here. 1.41, as we see, that's the lowest it's been going back the last several quarters. The PE, again, could be viewed as a little high. However, the company does seem to be turning a corner. So if revenue increases, then obviously that'll all kind of even itself out. Price to cash flow sitting here less than 20 now. It was at 30. Price to book down to 1.62, almost the lowest it's been, but obviously much lower than the average over the last 6-7 quarters. Return on assets, equity, and invested capital have all turned positive from negative here. Minus 14, 15, 16%. Now we're at 1.33%. Return on equity invested capital was minus 20+%. Slowly been climbing up and now sitting at 2.3, 2.25%, we'll call it respectively. Gross margin percentage we looked at before, as we see, up at 79%. That's the highest it's been going back the last several quarters. Operating margin percentage just shy of 5%, as we see, going from negative to positive. That's the highest it's been over the last several quarters. EBITDA, earnings before interest, taxes, depreciation, amortization, sitting here at 5.33%. Yes, it's down a little bit from the 6.6 number. However, look at where we've come from. So, again, you can't really knock it. The net margin percentage, again, going from the minus 20 plus up into the minus single digits, turns positive and now increases as of last quarter up to 7.81%. So, in my opinion, I like what I'm seeing here with Vimeo. And again, I feel here at 370 could be viewed as fair valued and potentially even undervalued. And that's why, in my eyes, I would personally begin piecing my way into a stock like Vimeo here. Now, it does look like, again, they're kind of just maintaining, as we see, even looking at forecasts here moving forward. 102.33 million, 103 million, almost 105, over 106, right? So, again, we may have hit a plateau where it may take the next year or two for the actual business to take that next leg higher. However, consistency is key, right? So even though these numbers are, a couple of million lower than the highs where they were, at the same time, on 102.33 million, if they post 103, they did their job. On 103, if they post 103.8, they did their job, and so on and so forth. So again, we're talking about consistent earnings beats here. Look at this green across the board. And if we switch annually here, we can see, yes, we're expecting a slight dip from our highs in 2023, about 414 million. Spoke about that before. 2024, almost 419 million. And then we're going to take the next leg higher, 450 million, 500 million. However, again, in my opinion, even with this quote-unquote plateaued revenue, foreseeably for the next 3, 4, 6 future quarters, I still feel, in my opinion, that the company is undervalued, especially the fact that it's in the tech sector, only trading at 1.5 times annual revenue with barely any debt on its balance sheet. This, in my opinion, these are the companies that should be rewarded. The EPS does seem to be bouncing around, but it is going to go positive, expected for 2023 of 8 cents a share. Then you can see we dip back down negative and eventually go back positive. However, in my eyes, it doesn't seem like the EPS is actually the story here, because as they turned it around, the company would have been seriously rewarded. And as we see, it's not. And again, we have these initial pumps and then it sells off. Here we were at the bottom of the range, so we had a big pump here, and then it began to sell off coming into next quarter's earnings. Then they come out and beat, we have a pop, and then it sells off, and now you can see we have a beat with a pop, and then it kind of sells off and slowly begins to consolidate here, tried to get back to the top of the range, but that was, yeah, towards the tail end of December. So as markets were climbing, this was actually kind of struggling a little bit. Now it's below the 20-day moving average there, so we're going to have to wait and see what goes on. But looking at the numbers here, again, I do like this one, in my opinion. And it does potentially seem like it's similar to some other stocks that we looked at that have turned out well. So, of course, only time is going to tell. But, we work with what we have. The MACD looks to be, slipping down since the ball dropped. We have been down more than we've been up. The RSI here on the daily, sub 44.5. So it was close to that 70 benchmark there on that pop. Looks like up to about 440 a share. And then we began chunking down and selling off. So can't really determine a move from the RSI, but again, always a decent indicator to keep an eye on. But it looks like here you can see it's fighting between these moving averages, and they've kind of intersected almost right at this point. We have the 50-day moving average on the daily at 371 and the 200-day moving average at 377. And you can see it was fighting to get back above that 200-day, and it rejected, and then it bounced and tried to stay above the 50-day, but then rejected. But you can see the stock is fighting and trying to bounce up and above that 50-day moving average. So again, we could have a rejection and we could drop down to 360, potentially 350, but in my opinion, it's only a matter of time before it regains and then climbs back here to the mid-Bollinger Band around 389, and then should get back up to $4 plus. However, again, the company is making higher lows and higher highs. So technically, it really should bounce here very soon and not make a lower low, and it should bounce up higher. But again, that's just my opinion. Looking here on the weekly, we can see the RSI was really sub 34. Wow. You're talking about 8-9 months here. So that's what I mean, the stock. But again, we looked at the numbers, right? So that's why here, after they completely beat it up and brought it down here to $3 and change, we could potentially say it's undervalued. Up here at $12, $15, again, you're talking 4 or 5 times the size of your market cap. So that's what, 2.4 to $3 billion market cap on a company doing around $100 million a quarter. So, it's understandable as to why it did have to kind of sell off and come back down to earth. I could appreciate that. But again, this is what, in my opinion, you should be looking for. You should be looking for companies that are turning it around, seem strong and sound fundamentally on their balance sheets, on their income statements. Let Wall Street beat them up and then scoop up shares at a deep discount and just wait for the rally and wait for the growth to take place over the upcoming months and over the upcoming years. So again, is it boring? Is it slow? Is it not an instantaneous 1,000% return? Correct. Do you have a much, much higher chance of making money with this investment simply because it is severely undervalued in the fundamentals, and we can say, quote unquote, in my opinion, it almost has to increase in value over time? That is potentially what we're talking about. And again, people thought I was crazy when we look at stocks like Fubo, Rolls-Royce, U.S. Steel, and you see how much percentage gains you could have made over the months and over the years if you just simply bought brand name companies at the deep discount that the market was giving you. Work smarter, not harder. That's what I always say. But as you see here, we got the mid-Bollinger Band on the weekly around 363. It seems like right now that's where the stock is trying to bounce off of. And also our 50-day here on the weekly, 379. That's why I'm saying chances are it should really regain those moving averages that we saw on the daily, 371, maybe 377 or whatever it was. And now you can see on the weekly, 379. That's why, in my opinion, we should technically pop back up higher and we could see around $4. The MACD that whole time was climbing up though, and you can see we're basically kind of flattened out here, But of course, you can see that look at how much tightening we have taking place here. Basically, throughout all of 2023, we're now in this tightening of the Bollinger Bands. And usually when that happens, based on what I've seen, in my opinion, you're going to see a break. And obviously, it could either break higher or it could break lower. But based on what we're seeing, again, I know it might not be the hottest name in the tech space. However, technically, on paper, in my opinion, this stock should break out of this Bollinger Band tightening and go higher, not lower. But of course, only time will tell. RSI on the weekly sitting here at about 48.5. Haven't necessarily hit our benchmark, but again, the RSI on the weekly was down here sub 30 benchmark for several months. So unfortunately, again, the RSI for the weekly cannot really be a big indicator for us. However, let's check the pivot points real quick before we go. As you see here, key level 404. Then, of course, it could drop down to 289. But like I said, if I like it at 371, I'm going to personally love it at 289. But, of course, whatever you do with this information is entirely your own prerogative. We switch over here and we can see right here this pivot point at 393. That's where the stock tried to maintain. But of course, when the ball dropped here in 2024, markets went down instead of up because everyone wanted to pump them for the last 8 weeks of the year, when in my opinion they shouldn't, when in my opinion it was off of fake news, obviously talking about Fed potentially cutting rates and inflation cooling. And now we find out that the estimated, the rate cut estimates or whatever have decreased, right? When everyone was saying they technically increased during this BS pump. And of course, now they came out and said, oh yeah, by the way, inflation is not cooling, and it was actually up for the month of December. So again, were a lot of people caught here betting against the market when it had this random pump? Yes, I'm sure, and I know it hurts. However, again, at the end of the day, we know what we know, and especially here in the States, if you left your house, you know that inflation is still very real and it is still climbing. So the fact that they were trying to pump up their stocks to make themselves money in the meantime while knowing that the economy is getting worse is just a joke. And now, of course, the cream is rising to the top. And we can see here this support level, next level looking at 347. And again, if it drops there, yeah, it's going to suck. But again, if I liked it at 371, I'm going to love it down here at 347. But technically, we did have this gap up, and we've been bouncing here since these earnings. So, it could have the potential to come back down and fill this gap. But we basically have to take what the market gives us. But the tightening here of these moving averages, and of course, looking at the Bollinger Bands as well, seeing the tightening down there at the bottom along the weeklies, in my opinion, it really should work out more positively than negative. But of course, only time will tell. Nothing is set in stone, and anything can happen. But this is an interesting sight to see, and in my opinion, if we do happen to have a nice breakout revenue quarter here, or potentially, around here 3 months later, then we could pop out and potentially start climbing back to the 5s, the 6s, and the 7s. So when it comes to Vimeo, is it the biggest name in the space? Is it the best stock we looked at? Technically, no. However, again, we have to take what the market gives us, and this is a company that I'm sure a lot of you are familiar with. And now, in my opinion, it seems like it's trading at a deep discount and might be worth watching and potentially owning if you want. But like I always say, if you see something that I didn't see in the technicals or in the numbers, please let us know down in the comments section. I always keep an open mind. I like to look at and hear all different vantage points and analyses from everyone. So, we have to take everything into account before we pull the trigger. But in my opinion, I think we just looked at a lot of pertinent information, and I feel in my eyes it is more positive than negative. And I'm going to end it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comment section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. Share the video. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, like I always say, I understand that markets are rocky and volatile and very uncertain. So I want to wish all of you success. Hope everyone makes a couple of dollars. Thanks for stopping by. Have a good day.